This conference is being recorded.
Okay, I think we'll go ahead and get started. I want to welcome you to the 8th and final webinar in our series this fall in early winter. It is a wonderful, cold, wet, rainy day here in Northeast Ohio. Hopefully it's nice where you're at. Today's session is going to be part 2 of the session on essential legal documents. We have Mary Gigante from Waldheger Coyne, a local law firm here in Northeast Ohio, doing this. And the first session focused primarily on good business strategies as far as legal documents go. Today's session is going to focus more on the transition documents. As you are heading into a transition out of your company, what are the legal issues and the documents that you need to have in place to help you through that transition process? So I think without further ado, I'm going to go ahead and turn it over to Mary.
Thanks, Chris. What I'm going to talk about today is, again, when you're ready to transfer your business over, whether that's to a third party or a family member, what sort of legal documents do you need? And even before you start talking about legal documents, there's going to be some steps you want to take before the documents are put in place. And so the first thing, and you've probably heard this from many business advisors, but you want to get the company ready for sale. You want to do a little bit of house cleaning. You want to make sure that legal and financial documents are updated, cleaned up, look appropriate. You want to make sure that you have actual legal title to the property. You would like to make sure that you have that you own your service marks or trademarks. So you want to do a little bit of housekeeping and a little bit of pre-due diligence to make sure that you have everything in order before you even approach a buyer. You'll also want to make sure that you have your advisors on board and are aware of your timeline. You certainly don't want to call up your advisors a week or two before you're ready to leave the business and say, I want to get out, help me sell my business. This is a definite process that is going to take some time. So you want to make sure that everybody's aware of what your timeline is and be able to plan appropriate for that. You also want to use your advisors to help them sell your company. They may know people within the industry or have other clients that may be interested in your business. So you definitely want to use them to help sell your company. And once you have a buyer or somebody that may be interested, that's really when you want to start the whole legal document process. And so you have a potential buyer, and what sort of legal document do you want first? Well, the first thing you want is a confidentiality agreement. You want some sort of agreement or even a letter agreement whereby you agree to open up your business, open up your financials to this potential buyer as long as they hold all that information confidential. And this confidentiality would also extend to their advisors who are also looking at the information. And again, what you want to be able to do in this process is to be able to freely openly discuss the business, the financial information, but still be assured that it's all going to be kept confidential. You also want to make sure that this whole process is being kept confidential. You don't want your employees kind of catching wind that the company may be for sale. You want to keep this whole process confidential. So that's the importance of a confidentiality agreement. Also, if the buyer looks at it, doesn't want to go through with it, or makes an offer that maybe you don't want to accept, and you both go your separate ways, then the confidentiality agreement should also address that you get all the information back plus all copies. So they should retain nothing as far as the company or its financial information goes. So once you actually go through this process, you have a buyer, they've looked at everything, you reach some sort of tentative agreement. How do you document that tentative agreement? That is documented in a letter of intent. And what the letter of intent does, so the buyer's preliminarily looked through everything, says it looks good, has made you an offer as the seller that seems appropriate, and so you want to go through this process a little bit further. So you want a letter of intent, and your letter of intent is going to outline the general terms of the possible sale, and during this time period of the letter of intent, there's due diligence that's still going to be performed, so it's going to be a little more intense, and negotiations are going to continue between the buyer and the seller. Now with your letter of intent, you don't want it to be open-ended. You want it to just be for a specific period of time. So whether the letter of intent is good for 30 or 60 or 90 days, again, whatever you feel is appropriate, because at some point you want to have there be an actual sale or, again, you part ways. A letter of intent is not a binding agreement, so if the buyer sees something during the due diligence process that makes it uncomfortable, it can still walk away. Or if you don't like how things are going with the buyer, or there's just isn't something that you like about the buyer as far as taking over your business, you can walk away as well. So it's important to note that the letter of intent is not binding. Again, it is confidential. You want to keep this confidential. And from the seller's standpoint, typically your buyers will say during this process, because they are investing quite a bit of time and resources for all this due diligence, that the seller is not going to be permitted to seek or accept offers from other third parties. So this is yet another reason why you want a time frame on your letter of intent, because if things don't work out, you don't want this open-ended where you can then not pursue somebody else.
Mary, quick question.
Yes.
Is it, kind of going back to the confidentiality agreement and the letter of intent, is it really difficult to ensure the confidentiality with outside parties? I guess, or the letter of intent, is it hard, is it easy or hard to prevent this stuff from getting out? Even though you have these legal documents in place, does the information leak, I guess, often or not?
Most of the time, no. In smaller businesses, we're dealing with the seller is the owner, and he'll basically have a lot of the financial and legal information going directly from either his accountant or lawyer to the potential buyer's counsel and or advisors. So a lot of this is kind of kept out of the selling company's offices, and then the buyer, obviously, if they don't, if they, even though you have the documents in place, if you're dealing with a reputable buyer, they are going to keep it confidential. But again, if they don't and it leaks, then that obviously tells you this is probably not a good deal.
Right. Okay.
With them.
All right, great. Thank you.
So once you have the letter of intent and you're going through this whole process, and things seem to be going well and the fit's going well, and you have the negotiations, after the letter of intent, what you're working towards is your definitive agreement. And again, a sale of your business can either be structured as an asset purchase agreement or a stock purchase agreement. And most commonly, purchases are an asset purchase agreement, which is an agreement to purchase the company's assets. And when you're basically taking over the company, it's substantially all its assets. And one of the reasons why an asset purchase is more common than a stock sale is because with an asset purchase agreement, the buyer is only going to assume the liabilities of the company that they accept under contract. Whereas in a stock purchase agreement, because you're purchasing the stock, the buyer is going to assume all the liabilities associated with that stock. So in order to cut off liabilities and to have a fresh start, most buyers will want an asset purchase agreement. Now with an asset purchase agreement, the taxation of the sale can be capital gains, but most of it's probably going to be ordinary income. It's all based upon the underlying assets. And then to the buyer, it's going to be deductible in the year of the sale, deductible over a number of years, or capitalized, again, depending upon the assets. What are some key terms of an asset purchase agreement? Well, obviously you want to specify what assets are being purchased. You can state, for example, all the assets are purchased except for the following assets, and you can list out the ones that are not being purchased. Or you can specify what assets are being sold, and then everything else remains with the seller. So some of the assets typically purchased in an asset purchase agreement would be obviously the hard assets, furniture, equipment, computers, contracts, customer lists, business forms, processes and methods, the company name, trademarks, and goodwill. You also want to specify assets not to be purchased. Typically that would be cash, accounts receivable, and personal items. So as the seller, if you have some personal desk or some personal artwork within the company, you'd want to list those out as not being sold. And then specify any liabilities to be assumed. Again, with an asset deal, the liabilities do not automatically flow over to the buyer. Those need to be specifically assumed. Okay. Payment terms, the document should also specify the payment terms, if it's going to be a cash transaction or if it's going to be paid over time through a promissory note. And if you have a promissory note, then you obviously, as the seller, want to have as much security as possible to make sure that you get paid. So some common forms of security would include a security agreement on the assets, which would include the financing statements, which are filed with the Secretary of State, mortgages on property if you're selling real estate, access to financial information. The reason you would want that as a condition is you want to be able to see that the company is still performing and able to pay you. So you would want to see their financial information. Life insurance on the buyer or the key person in the buyer's company that's taking over your business. Same with disability insurance. You would want property insurance on the assets and real property. And you want the ability to accelerate payments on the promissory note if they would violate any term or the purchase agreement. So again, you want to make sure you get paid. Obviously cash, even if cash is a little bit less, generally is better because it's known, it's immediate, you have it. With the promissory note, there's always a risk and a chance that you may not realize that true value. Another key item on the asset purchase agreement is there going to be an escrow or an holdback? Does the buyer want a period of time to make sure, for example, that all of the customer contracts are transferred or that key employees stay with the company? So there may be some sort of holdback for those special items. Okay. What representations and warranties are going to be given by the seller? Typically when you sell your business, you just want to sell it as is. You want the buyer to assume all responsibility for their due diligence and checking everything out. The buyer, on the other hand, will want some representations and warranties since they've only had a short period of time to look at the assets and the business, and they would want you, since this is your business, to make certain representations and warranties to them as to the viability of the company. So this is always part of a lot of the negotiations as far as what the representations and warranties are going to entail and what they're going to say or not say. And again, you want to be very careful reading those over and make sure that you're not guaranteeing certain facts or certain things exist where maybe they're not. So this is part of the contract that needs to be looked at very carefully. What are some of the conditions to actually closing the sale? Well, you want to make sure if they're taking over your business and you're renting the warehouse, you would want to make sure that they can come in and assume that lease of the warehouse. So you would want to talk with the landlord to make sure that they can assume that lease. Or if the buyer wants to move the operations, you would want to take a look at that lease, and if the buyer is not going to assume that lease and it's still with you, the seller, Can you terminate it early? Can you get out of that lease, or are you still going to remain liable on that lease even though you're not using the warehouse space? So those are things you want to look at. You also want to look at if you have some key customers, can you get commitments from them that they are going to continue to do business with the buyer? And again, this can be very sensitive. A lot of times what happens in this particular situation is that the buyer will ask the seller to stay on for a period of time to help transition those key customers. And then the buyer and the seller typically will go out to the key customers, announce the sale, and work out that whole transition. So that's typically how that's done. Commitments from key employees. If you have good management and the buyer wants to buy that good management team, obviously the buyer is going to want to make sure that they are staying there. You also want to, the buyer may ask for the seller to have a non-compete agreement, which simply means that when you sell your business and the buyer is purchasing it, they don't want you to come out and compete with them, set up a whole new business. So in a sense, they're going to also buy your agreement not to compete with them, and then acting as a consultant. And again, typically these contracts will also indicate that the agreement is to be confidential, that the terms of it are all to be confidential.
Mary, quick question.
Yes.
When you're looking at one of these agreements, I was thinking about one of the slides previous where it can get down to describing personal items and desks and chairs. Mm-hmm. Do they often get that specific? Where it says this, brown leather chair is going with the seller. Does that make sense? Does it?
Yes.
Okay.
Yes. Yeah, and sometimes it may just reference like all personal effects in the president's office.
Okay.
But you may actually go in with the buyer and kind of tab what's the personal effects so that they understand, because as a buyer you don't want to assume that you're getting all the office furniture and then the day after the sale you come in and you have an empty office.
Right.
So some of that does get pretty specific.
Okay. Generally, how long are these types of documents? Are they 5 pages, 100 pages? They're pretty intense.
They can range depending upon the complexity of the transaction. The actual agreement itself may be 20 to 50 pages.
Okay. But
then the schedules that list out like all the assets to be sold, the assets not to be sold, any schedules explaining representations and warranties, problems that you don't want to necessarily represent or warrant, or if you have to list out all the contracts that are being sold, the schedules, the attachments to the agreement itself can be double what the agreement is.
So it's a very serious agreement.
Yes.
Okay.
Yes. It is because if there's any issues, if there's any one thing that I didn't mention, depending upon what sort of indemnifications you give or don't give, there may also, or any representations or warranties you give or don't give, there may be an indemnification provision where if certain things that you said aren't true as the seller, then you agree to indemnify the buyer for those losses.
Okay.
So these agreements become very important, a year or two down the road where maybe certain contracts weren't transferred or maybe they weren't valid, and you have to go back and look at your asset purchase agreement to see, okay, were they purchased, were they not purchased, what all did this entail?
Right.
So they do become very, very important documents.
Right. Okay, thank you.
Right. Yeah, it's not something you can put together overnight.
Right, or download a form off the internet.
Right.
Okay.
Right. All right. So that's kind of, in a nutshell, some key items on the asset purchase agreement. The other type of way that you can sell your company is through a stock purchase agreement. And again, with your stock purchase agreement, you as the seller are agreeing to sell stock in your company. And again, you can sell all the stock or a portion of the stock, so you'd want to specify that. With the stock purchase agreement, as a shareholder and purchasing the stock, you are going to be liable for that company because you're taking it over. So you're going to be responsible for all liabilities, whether they're known or unknown, unless the agreement provides otherwise. And then the taxation, yes?
How specific can a stock purchase agreement be to eliminate liabilities?
Well, it can certainly try to limit liabilities, but again, when a third party sues the company, they're going to sue the company in and of itself, and then it's going to be up to the new buyer to be able to reference back to this agreement to probably be indemnified by the seller.
Okay, so you could indemnify, a buyer could indemnify themselves through the stock purchase agreement to a certain extent. Right.
And from the buyer's standpoint, if there are some questions, then, for example, maybe you don't want to make this a cash transaction,
right.
Or maybe you want to have
back some cash.
Right, have a holdback. Right, have some money escrowed, or just pay them over time. So if some of these liabilities do come up, that you can have a source of income to pay it, because obviously once you pay the seller, there's no guarantees that you're ever really going to be able to get the cash.
Right.
Okay. Then the taxation of a stock purchase agreement for the seller is capital gains since you're selling the stock, and the buyer capitalizes. Okay. So what are some of the key terms of a stock purchase agreement? Obviously the number of shares sold, the purchase price, the payment terms, and again, if you're the seller being paid over time, you want to make sure that you have a lot of security to guarantee that payment, which would include everything we talked about under the asset purchase agreement, plus having the shares pledged. Now, having a promissory note and having the shares pledged is not necessarily best. You obviously would want cash, because if things aren't working out and you're not being paid, it's probably because the company's not doing well. And for you to come back into the business, number one, as the seller, do you really want to come back into the business? And then number two, what condition is the business going to be in when you come back in because you're not getting paid? So it's not a perfect sort of security on getting paid. But again, you want to just make sure that you have as much security as possible. But I guess what I'm suggesting is obviously cash is better than payment over time, if you can help it. Okay. With the stock purchase agreement, the liabilities section, obviously the seller is going to want all the liabilities assumed except for certain liabilities that are going to be stated on the schedule. And then the buyer is only going to assume liabilities that are specifically stated on the schedules or in the agreement. So this goes to Chris's point earlier, which is how long is the agreement? With the stock purchase agreement, you're talking about liabilities, whether liabilities are assumed or not assumed. This is a very important schedule, because if there's any sort of litigation or questions after the sale, this is typically the part of the agreement that's looked at as far as, well, is this a liability that the seller assumed or did not assume? So again, this is it's very critical to make sure that these schedules are complete as much as possible. And then the representations and warranties, again, this is going to be very specific and detailed, because in a stock sale, again, the seller is going to have a lot of the liabilities. So again, this is going to be critical to read over every word and make sure that you're only guaranteeing or attesting that certain things are true if in fact they are true. Okay. What are some of the conditions to closing? Again, if you're buying the company, you'd want the seller to not compete with you. And for the transition period, you would want the seller to act as a consultant for you. And again, you would want this agreement, the terms to be confidential. Okay. So if we move on to some of the ancillary documents that go along with a purchase of a company, the consulting agreement, typically you want the seller, because they have so much knowledge and history of the business and so many contacts in the business community and with customers regarding the business, that you just don't want them walking away. You want them to help transition that information to you. So typically you will have and see consulting agreements with these transactions that can last anywhere from a year to a couple of years typically. And the seller is going to provide services to the new company. Again, you want to transition customers, transition the business, share the information. And this consulting agreement could be either an employment agreement or an independent contractor agreement. And then from the seller's standpoint, they can certainly ask for fringe benefits, health care, that type of thing through this arrangement. You want to outline the payment terms. And any payments under the consulting agreement would be taxed as compensation earned income. Okay. Then another ancillary document is the non-compete agreement. And again, what this document is that the seller, when they sell the business, they're not going to compete with the business they just sold. Those non-compete payments, if you are going to have a non-compete, you need to assign some sort of value to that. Your accountants, both the buyer and the seller accountant, should work together to make sure that the transaction is being reported appropriately and the same way by the buyer and the seller to make sure things are reported consistently with the IRS. But again, your non-compete does need to have a value. Whatever those payments are and as frequently as they're being made are taxed as ordinary income. Okay? And the non-compete should specify, obviously, the time limits on which you cannot compete, any geographic limits. You want to prohibit the solicitation of customers, prohibit the solicitation of current employees, and also prohibit that former seller or the seller from owning, working for a consulting, or establishing a new company that would be in competition with you.
Mary, is it safe to say that the more restrictive the agreement, the more value that agreement has, and ostensibly the more, by assigning a value to it, you're assuming that you get extra, over and above the value of the company, you get some type of compensation for that.
That's right. That's right.
And the more restrictive, the assumption is the more compensation you'll get.
Right.
Okay.
That's right.
Are they generally hard? Is it hard to bargain that out as to the level of restriction versus the level of compensation, or is it usually pretty straightforward? Does that make sense?
Yeah, it's usually actually the entire sales price and these ancillary issues are all kind of negotiated at the same time, so it's really one package.
Okay.
And then it's okay. Now, how do we assign the different values to it? With the consulting arrangement, it just may be a specified amount per year, or per month, and then you're just called on as needed, but maybe it's not to exceed 20 hours a week, for example.
Okay.
And same with the non-compete, depending upon, again, how restrictive it is, you just negotiate that number. But again, when you're looking at this, you're looking at the whole package. It's not necessarily that you negotiate the sale price and then you do these other items. It's all done together.
Okay, makes sense. Thank you.
Okay. All right. if we look over to what if we want to transfer to a family member? If you transfer to a family member, and before we were really talking about transferring to an outside third party, if you transfer to a family member, it can be structured as a sale or a gift or even a part sale and part gift. And if it's a sale, those family transactions are going to be scrutinized, obviously, by the IRS. And to defend yourself, you should have some sort of formal valuation to document the sales price. The argument with the IRS in family transactions is going to be that they paid too little, and so you're going to have a deemed part sale, part gift issue, which could obviously have tax implications to you, which you would not necessarily want. So you want to have a valuation anytime you're transferring to family members. You can use, if you're going to sell it to the family member, you can certainly use the stock purchase documents discussed above. And again, you would want to show the IRS that you're really treating this at an arm's length negotiations, arm's length transaction by using a document similar to what you would have had with a third party. If you are going to have the family member purchase the stock over time, then you would want to have a buy-sell agreement with them. And basically your buy-sell agreement, you want to have a shareholder, whether they leave the company, die, or become disabled, or retire, that those shares go to that family member you're bringing on board or are sold back to the company, or something happens to them so that your succession plan that you've put in place can continue on. So when you're doing, again, the stock over time, whether it's a gift or a sale, you want to make sure you have a buy-sell agreement so that your succession plan can continue on. Okay, if it's going to be a gift, you need to document the gift. So you would want the family member who's making the gift to sign a gift letter documenting the date, the value, and the amount of shares of the gift. You obviously want a valuation for this to document and to back up the gift letter. And then you need to follow through with that and actually have the shares transferred. So you would need to have your share certificate canceled, reissued for any remaining shares that you still own, and then have a new share certificate issued to the person that is receiving the gift. And a lot of times, the details aren't sometimes followed. You'll do the first part, but then you'll forget to actually take the action of transferring the actual shares. So you want to make sure that that's all done. And then you want to consider filing a gift tax return, particularly if you're doing what's called gift splitting, if you're gift splitting, meaning you're giving more than the one person annual amount because you and your spouse are gift splitting, or you're gift splitting to the family member and their spouse. Or you want to file a gift tax return because you want to document and file with the IRS the valuation. And if you do it properly, then the IRS has 3 years to review, and if they want to challenge your valuation after that time period, after the 3 years expires, if they have not challenged your valuation, then your valuation is deemed correct. So you want to give serious consideration, again, if you're doing this, to filing the gift tax return to get that value to get the value of the shares documented. And anytime you're transferring to family members, if the senior family member wants to start giving some of the value of the company, but not necessarily wants to give up control of the company, then you can use what's called a closed corporation agreement, which is basically a shareholder agreement where the shareholders would agree that controlling voting authority rests with the senior family member as long as they own one share. So it's a shareholders agreement whereby if the family member then is gifting shares to his child that's coming into the business but still wants to be able to control the company and make all decisions, they can sign a closed corporation agreement whereby that is all true. Okay. In looking at how to transfer a business to family members, there's also other vehicles available. For example, something that's called a GRAT, but that's really beyond the scope of this current presentation. But I at least want you to be aware that if you are transferring to family members, there are some other avenues that you can look at that may be tax effective. So I wouldn't solely just rely on a sale or a gift. I would look at other issues and other avenues that should be explored. Okay. And then quickly, I just want to spend a couple minutes talking about the buy-sell agreement. Because again, if you're transferring shares and you're not transferring 100% of the shares, or you want to make sure that you have this agreement in place to make sure that your succession plan, should something happen to you, whether you die, become disabled, or retired, that succession plan continues after you are no longer able to or in control of the situation. And so the buy-sell agreement is an agreement between the shareholders, what's going to happen to their shares upon specified events. So if you're for example, if you're the selling shareholder, you would want to have a buy-sell agreement in place with your family member that's taking over the business that basically states that should I die, become disabled, or retire, my shares will either be transferred to the family member or redeemed by the company. And then your agreement can specify what the payment terms of this transaction would be. So that way you're keeping it within your succession plan as you have designed it, rather than, for example, if you were to die and your shares were still in your name and your will just said split equally amongst my kids, those shares may go to all the kids as opposed to the one child that's just in the business. So again, you would want your buy-sell agreement to be able to specify and be consistent with your succession plan. And let's see if there's, your buy-sell agreement can state that if you want payment to go to your estate, for example, or if you're retired to pay you off, you can, again, specify the payment terms, whether it's going to be a lump sum or installment. So again, this provides you flexibility, and you should look at your buy-sell agreement as really being part of your overall estate and business succession planning. Again, particularly when you're transferring part of the business to a child. Okay. That's about what I had. I don't know if you have any questions.
Do we have any questions? No?
No, I'm good. Thank you. This was an excellent presentation, Mary. Thank you.
I want to pull up Mary's contact information for people. Again, I'd like to echo Mel's statement that I thought this was excellent. Good introduction to some of the documents. I had a quick question, and it kind of relates to a question I had earlier, in that, one of the issues we see often with, especially the smaller business owners, getting under 50 employees, they see a lot of these things, and they automatically think that, it happens with getting evaluation done. It happens with getting all these legal documents done. It's kind of a two-part question. One is, would you recommend for a legal document issue to going to a specialist, i.e. someone who focuses on this area of the law, or would you feel comfortable telling someone they can go to their day-to-day lawyer, so to speak? And the second part would be, kind of like the off-the-shelf agreements on some of these things, especially, we talked about the purchase agreements, but like with a buy-sell, there's kind of like standard boilerplate to buy-sell agreements. How leery are you with using kind of like the standard? how focused should a business owner be on getting something that's really structured for who they are and what their business is and what their ideas are. Does that make sense?
Yes, yes. I guess I would answer that. Certainly, you need to look at this, that your business has been part of your life, and you're transitioning it to another generation or another party that hopefully is going to hold it the same way that you've held it, and you certainly don't want to transition it in a manner that's going to cause harm. So I would be leery of an off-the-shelf type of document, simply because unless you understand why each section is in that agreement, or unless you understand the rationale behind it or what it means, it probably isn't going to serve you appropriately. You want to get a document and you want to talk to somebody that is listening to you and that understands what it is you're trying to accomplish, because every situation is going to be different, and there isn't any sort of boilerplate document that's going to cover all situations. So you want somebody that's listening to you and be able to draft a document that addresses your particular issues. Because what you don't want to have is just a boilerplate document that doesn't necessarily address your issues, or worse, addresses your issues in an inappropriate manner or in a manner that you didn't intend for. So
right.
That's kind of, I guess, the answer to that question. Then the answer as far as your general counselor, your general advisor, I think that they're an important person in this process. However, as you can see from a lot of the discussion, there's a lot of interplay between not only your business planning but then your personal planning. And so you want somebody that understands all of these issues, the family transfer issues, the documentation issue, as well as some of the tax issues. So I might suggest that your general advisor should be part of this succession planning team, because they're going to have a lot of information, a lot of knowledge about the company or about your personal situation, but maybe they don't have a lot of the technical background in this. And so I would try to build a whole team to help you transition the business, because I don't think it's just necessarily one person that can do all of this.
Right. My argument is that finding the right person to do this stuff is, while the upfront cost may be something that you weren't prepared for, I look at it as, in a sense, an insurance policy to actually accomplish what you want to accomplish and the way you want to accomplish it is always going to cost a little bit more money, and that's an issue we deal with, especially as I mentioned, the real small companies who just see the where these bills just they think that these are just going to keep on adding up, and I don't need this professional to do this. I can accomplish it with what I have now, and it just seems putting short-term gains of a relatively small nature in front of the biggest transaction of your life, probably. You know what I mean?
Right. Well, and it's transferring part of your life's work, and it's your legacy, and how are you transitioning it, and how are you protecting it, and protecting if you're looking for a stream of income from this through payments, how are you protecting yourself as well? And particularly in a family situation, if things don't go well, then that can get very uncomfortable, and so you want to make sure that you're not creating problems or creating family tensions where there doesn't need to be any. Because I do agree with you, Chris, is that while it may be a little expensive on the front end, you're going to save yourself a lot of heartache and a lot of expenses on the back end if it's not done appropriately or things are not thought through completely in all the way.
Right, and the saddest example is the case of families that don't talk to each other anymore. based on these
Right.
issues. And, you spent 40 years not just building the company, but building your family, or however many
Right.
years it was, and it gets destroyed because you wanted to save, $10,000.
Right.
It's just a sad thing to watch. So.
Right.
Okay.
Right.
Great. Again, I want to thank Mary for the excellent presentation. Again, her contact information is on the screen if you want to get a hold of her. We really appreciate her coming out and doing 2 sessions for us in this series, doing the yeoman's work there, or the yo persons. Sorry about the proper syntax.
That's fine.
Okay. I want to remind everyone that we are going to be doing a new series of webinars coming up in the spring and early summer of next year. And also that any webinar in this series that you may have missed, including this one, will be available up on our website for viewing at your leisure. The first 7 are up. This one will be up later today. If you have any questions, feel free to get a hold of us, and thanks for stopping by. I'm going to go ahead and turn off the recording now.
Thank you. Please stand by.